to cut carbon emissions globally is throwing up challenges for our economies, and this could also have an impact on our investments. Prominent figures like Bank of England Governor Mark Carney have warned of these climate risks, and more investors are adapting their strategies. In this next chapter, I'm speaking to experts at Schroder's and HSBC's pension scheme, which has taken the pioneering decision to change the default investment option to a sustainability-focused fund. I have asked Mark Thompson, Chief Investment Officer, why he made this call.
The main reason it's the right thing to do for my members. And the reason for that was threefold. The first two involved me getting FTSE to create a new index. The first part of that was I wanted to get a better risk-adjusted neutral position. The second part of it, which is really relevant for the conversation today, is how we incorporated some climate change protection into that index, both by tilting away from carbon reserves, tilting away from carbon emissions, and putting more emphasis on green revenue. The third part was to take my incumbent manager, who are Legal & General, and get them to change my default fund to manage against that index, and that became the Future World Fund. And the main point of change there was better engagement with the main companies in the world globally, about 80 or 90 of them, that would have the biggest effect on climate change. So the manager has written to the chairman of those companies and asked them to explain how they are transitioning their business to be consistent with a sustainable world. And if after a year of engagement they are not making good enough plans, then even though that company is part of the index, we will take it out of the fund.
Oh, that's quite a drastic measure. Okay.
Focuses the mind.
Does that mean, when you look at the returns that you've had so far, that it has made a difference? Has there been a change in it? Or has there been a change in perception mainly?
I think it's a little early to say that performance has been either good or bad compared to where we were before, because we actually made the transition in January of this year and it's now August. I mean, it's going fine, but at 6 months or so it's a little too early to make that. What I have noticed though is that in the discussions I've had with my members, and particularly the younger members, the millennials, they've taken a lot more interest in the fact that our mainstream fund incorporates sustainability or climate change protection in it. And I think that is something that's very positive, and I'm hoping that make them more interested in pensions and investment than they would otherwise have been. Have
you seen any change in the company's reaction to this? When Legal & General gets in touch with them and says, well, what have you done? Have they actually become more environmentally aware? Certainly the engagement that Legal & General are doing with companies on behalf of the asset owners is a very positive step, and I think that's a trend that we'll see more of. Well, what would you say to your colleagues in different companies managing the pension scheme there, if they are considering something like this? What do they need to bear in mind? I think an issue is that what I've done, we believe, my trustees believe, is completely consistent with their fiduciary responsibility. Everything's down to our fiduciary responsibility, and I think more trustees generally around the UK are coming to that way of thinking. And what we've done in our scheme is one answer to that. I think there will be other answers to that problem, but more people will be considering it, and I expect more of a proliferation of these type of funds over the next few years, which I think is a fantastic sort of outcome. Schroders is one of a growing number of asset managers warning of climate risks and the need to act. I met with Jessica Ground and asked her, how important is it to make investors aware of these risks on their portfolios?
So we've identified it as one of the major investment challenges for the world going forward. On our estimates, we think we're heading for a 4-degree rise in temperatures, which would be double what the scientists think is a safe level. And at that level, you start having the really huge risk of natural disasters hitting GDP. And that also means, as well as that increased risk, that there's an increase in financing challenge. We need to have more actions. So investors really need to think how capital is going to shift, what are the opportunities, and then also how to insulate their portfolios for some of the risks from this change at the same time. Because this could have an impact on some companies. Under our analysis, there really isn't a sector that is unimpacted. As the world starts to really price what the true cost of carbon, you're going to see the economics of a lot of sectors change quite radically. And some of them will still be able to maintain their demand, and some of them are going to become uneconomic. So if you're a bank, you really need to think about your lending book, and you really need to think about whether the companies you're lending to are going to be sustainable as we move towards correctly pricing carbon in our global economy.
Bearing in mind these climate risks, if we look at all the different actors, what role should they play?
Well, any problem of this global and systematic nature has got to have a systematic response. And what's interesting, over the past 18 months, we're really starting to see that happen. So, for example, the Bank of England, the regulator, is starting to get much more involved in this and really start to think about what the regulatory implications are. Policymakers, particularly in the EU, have started to be thinking about how they can create a much better backdrop to encourage much more sustainable investing. As well as banks in particular have a huge role to play in that. They can think about their own lending policies, and they can also think about the opportunities and types of products that they can do to help finance. There are going to be risks, but there will also be some quite good opportunities, and banks are quite well placed to well understand both sides of that equation.
So from an investor perspective, how important is it then to see boardroom commitment in a bank for sustainable finance?
Well, it's great to see the chief executive committing to it, but what's even more exciting is when you start to see the changes across the business. So whether it's from the pension fund, which has adopted a different approach to its defined contribution scheme, the much greater activities and levels of green bond underwriting, the commitment to deliver more sustainable investment solutions to clients, particularly out in Asia. We think there's a great demand for it. And then also to think about infrastructure financing, balance sheet and lending policy to high carbon and low carbon. And it's really only by embedding this across the bank, not just at the top, that HSBC will really be in a position to play a major role from the carbon transition, making sure they're insulated from the risks, but also benefiting and financing the opportunities.